Hello, good afternoon, everyone. Welcome back again to the finance class. We have already arrived at our 10th week, right? Okay, let us continue for the material. Today I'm gonna talk a little bit about the cost of capital. There are several topics that I will discuss this week. The first one is talking about the concept of the cost of capital. The second one is how to compute a firm's cost of capital. Yeah. And then the cost of individual sources of capital, optimal capital structure, marginal cost of capital, as well as a little bit about how to combine the MCC and IOS. Okay, now the first one, we're going to talk about the concept of the cost of capital. When a firm invests money in a project, it should earn at least as much as it costs the firm to acquire the funds. Therefore, the cost of capital may be defined as the minimum acceptable rate of return. The term cost of capital has also been referred to as the firm's required rate of return, or the hurdle rate by the investors, as well as the opportunity cost. So basically on this point, you can see that the cost of capital reflect, the number that basically, give us a clear image of what is actually the representation of the cost of operational cost within the companies is. Basically, when we talk about the cost of capital, when we talk about the cost of capital, it represents how much efficiency that the companies has already been at. You can see right here, when we talk about the cost of capital, a higher number of a cost of capital, it reflects it reflects a high level of inefficiencies within the management. Why? Because a high number of a cost of capital represents the company's inability to operate efficiently. Yeah. Therefore, a high number of a cost of capital represent a slightly higher number of risk, compared to the lower one. That's why cost of capital, the company always try to make it at a bare minimum. Yeah. Why? Because when the company decide to make it minimum, for the cost of capital, that means that the company also, able to tackle his efficiencies process, and also at this point, that means that the company has already made mitigating the risk, specifically the systematic risk within the company's organizations itself. And therefore, it is one of the company's efforts to lessen its risk. Remember that one. Yeah. A higher number cost of capital represents a higher number of risk. A lower number cost of capital represents a greater number of efficiencies within the management, and therefore it is a good signal for the investors. Yeah. Okay. Now we're going to talk about how to compute a firm cost of capital. Remember, I have already mentioned to you guys before when we talk about the cost of capital. There are two types of cost of capital. The first one is the cost of capital if you view it individually. Yeah. The second one, is a form of cost of capital. Yeah, is a few mm, a composite. Yeah, and a composite level. What are the difference between those? Remember, I've mentioned to you guys before, when talking about the firm cost of capital individually, that means we're going to talk about the firm's cost of capital, cost of debt, cost of equity, also, or cost of retained earning, or cost of new stocks individually. Yeah, let's just say if a firm has external sources of funding, using only 100% financed by debt, that means that the firm cost of capital only covers the cost of debt 100%. Yeah, it doesn't have any cost of equity, it doesn't have any cost of retained earning, it doesn't have any cost of preferred stock. It only consists of a 100% cost of debt. Remember that one, yeah? And then if the company said, let's just say, for this company A have been financed by using the equity, by using the equity as well as the debt. How much percentage, yeah? Each offers, let's just say for these firms, 50-50, 50% debt and then 50% equity. Yeah. What kind of equity is it? Using the cost of retained earning because they're simply using the number of retained earning earned by the previous by the previous activities and then refinancing and using it invested again for the next operational activities. Okay, that means that for these firms, yeah, the cost of capital will be consist of a two part. The first one is 50% the debt, and then the second one is 50% by using the cost of retained earning. Yeah, that's why for this firm, the firm cost of capital will consist of a combination between these two. That's what we call firm cost of capital and the composite level. Okay. Okay, now we go back into the presentation files. Weighted cost of capital. For a given amount of investment capital to be raised, the cost of capital is a weighted average of the after-tax cost of the individual sources of financing. Here is an example. The first one, yeah. Assume a firm wishes to raise $10 million using 40% debt, 10% preferred stock, and a 50% common equity financing. They're given the following. You guys were asked to calculate the firm's cost of capital. You guys can see right here for the source of financing, we have three sources. The first one is the debt, the second one is the preferred stock, and the third one is the common equity. Yeah. And then for the after-tax cost for the debt is 8%, and then the weight is 40. Yeah, 40%, right? And then for the preferred stock, the after-tax cost is 10%, and the weight is 10%. And then for the common equity, for the after-tax cost is 40%, and the weight is 50%. You guys can see right here from the weight here, 40% plus 10% plus 50%, this will be equal to 100%. Yeah, that's why, yeah, from this point, you can calculate the weighted average cost of capital. And simply multiply this one, yeah, 0.8 multiplied with 8% plus 10% multiplied with 10% plus 50% multiplied with 14%. Then you will get a number of 11.2%. 11.2%, this is the number of a weighted average cost of capital. Okay. Now, what are the costs of the individual sources of capital? This is the one I mentioned to you guys before. You can see from this example, the debt, the preferred stock, the common equity. These are the sources of individual cost of capital. It does not necessary for the company to have three types of source of financing. This is just the common one, but not all company have external sources of financing from these 3 points. There's a company financed by using 100% debt. There's also another company using 50% preferred stock and then 50% debt, yeah. And then there's also a company using 100% common equity, yeah, no debt and no preferred stock. It's depends on the company's governance itself, okay? And then what set of weights is appropriate in the capital structure? Remember, yeah, I have already mentioned to you guys before when we talk about the capital structure. The capital structure talk about the ratios between the capital as well as the debt, right? So basically, we're going to be talking about the ratios between the strength within the company and then the strength outside of the companies. How much dependencies that company have the internal one compared to how much dependent the company has to the external factor one. Okay, and then the capital structure talking about the balance between those two. Yeah, so that means, the appropriate capital structure is basically, the types of, this one is basically the capital structure that is able to less the number of a risk within the company. So that means when we're talking about the number of a cost of capital, yeah, in a level number, yeah, I mean, yeah, the number of a capital structure, yeah, the number of a capital structure, we can talk about 70% the debts, 30% equity, or 50% debt, or 50% equity, yeah, or 100% debt, or 100% equity, or 100% equity, yeah. Let's talk about four options, yeah, four options of a capital structure. Between these four, which one is basically give the less number of risk to the company? Which one from these four structures basically give the a minimum number of a cost of capital? That's what we call for the optimal capital structure. Okay, remember that one. What is the relationship between the cost of capital and the amount of investment capital to be raised? Yeah, you can see right here. Yeah, I've already mentioned to you guys before. Yeah, the number of a cost of capital, the high number of cost of capital represents a high level of risk, right? And then technically, yeah, the company does not like risk. So if it's too much, because it gives a bad signal to the company. That's why the number of a cost of capital should be decreased, yes, to reflect the efficiencies within the organizations. Okay. Now, cost of individual sources of capital. You can see right here, yeah, debt. This one is basically we call the cost of debt. How can we calculate the cost of debt? Technically, yeah, this is the basic formula. You can simply calculate the cost of debt by using the before tax cost of debt, yeah, and then you multiply it with 1 minus marginal tax rate. Remember, yeah, marginal tax rate will be different, yeah, compared to each company, right? And then, yeah, we'll talk about the before tax cost of debt. You can get it, yeah, from the number of interest rate on a new debt or yield to maturity on a bond, 30-year bond. Okay. Uh, okay. And then flotation costs on a new debt, if any, have been ignored, since the majority of debt is privately placed and has no flotation costs. If, however, bonds are publicly placed and involve a flotation cost, an adjustment could be made to the before tax cost of debt. Yeah, remember that one. And then the second sources of a cost of cost of capital is the cost of preferred stock. If the company have preferred stock, then if the company sell preferred stock, then yeah, you will need to calculate cost of preferred stock. But if the company does not have cost of preferred stock, then yeah, you don't need to calculate this one. Okay, now cost of preferred stock. How can we calculate it? Just simply put it into this formula. The annual dividend divided with price of a preferred stock minus the flotation cost. No adjustment for taxes is required since preferred dividends are basically not tax deductible. Remember that one, yeah? And then the third sources is the cost of common equity. The rate of return required by the firm's common stockholders. An opportunity cost concept, for example, what rate of return could the stockholders earn if they invested the funds in other alternatives of comparable risk? It is extremely difficult number to estimate, but technically you can calculate it by using the Gordon model as well as the DCF formula. Yeah. Here for the cost of retained earning, the formula is like this. Dividend at the end of year one divided with the price of the stocks plus growth. The growth of the stock itself. Okay. Uh, now, how about the cost of a new common stock? If we calculate the cost of a new common stock, especially if the company decides to finance its own operational activities by using the IPO, yeah, that means that we're gonna need to calculate the cost of a new common stock. Yeah, how we can calculate it by using the constant growth in dividend models. How's the formula? The formula is like this. Dividend at the end of year one divided with price of the stock minus flotation cost plus the growth. Yeah. If it were not for the flotation cost, the cost of a newly issued common stock would be equal to the cost of retained earnings. Now, both sources of common equity. You can see right here, yeah, you can see right here, yeah. The cost of common equity. We have a cost of retained earning, and then we have a cost of a new common stock. Yeah, because there an addition of a flotation cost, that's why the cost of a new common stock will be even more expensive compared to the cost of retained earning. Remember that one. Yeah. Now, how can we calculate the cost of common equity? Technically, we can use the Kappa model. This is basically the most simplest one. Yeah, how you can calculate it? Simply put it this one, yeah, to this formula. Yeah, how this one. The cost of common equity equal to risk-free rate of return. This one, risk-free rate of return, plus the market risk premium. Yeah, the market risk premium, and then you multiply with the beta coefficients of the company. Yeah, the risk-free rate of return we're using, yeah, the 7-day repo rate. Yeah, and then for the required return on the market minus the risk-free rate of return, this is what we call the market risk premium. A higher number market risk premium, that means that a higher number of strength within the company compared to its peers. Yeah. And then the beta coefficient. Beta coefficients, yeah. Beta represents the systematic risk of the company. If we have a beta, if we have a beta and a positive value, that means that the risk of the companies itself, the movement of the companies itself, yeah, will basically move similarly with the way how the market is. You can see right here, let's just say, yeah, if the market beta is 1, yeah, 1.5, yeah, let's just say 1.5. Okay, that means that if the market increase 1.5, then the movement of the companies itself is also going to be increasing, yeah, 1.5 times, okay? Remember that one. If the beta is negative, that means that if the market increase, then the companies will decrease. If the market decrease, then the company is going to be increased. It moves, yeah, in a reverse way if the beta is negative. If the beta is positive, it moves in a similar way, yeah, aligned, okay? Remember that one. Oh, this one. Yeah, the beta coefficient, it is a measure of a market risk or systematic risk within the company. Okay, it measures the extent to which returns on a given asset move with the overall market. You can see right here the beta, yeah, the ratios of the beta itself represents the ratios between the changes in the asset return divided with the changes in the market return. A higher beta means greater risk. For example, a beta of 2.0 indicates that an asset's return should increase 2% for every 1% increase in the market. Conversely, the asset's return should decrease 2% for every 1% decrease in the market. Yeah. You can see right here, yeah, it presents, yeah, the line, yeah, there's the market, yeah, the SML, the security market line, right? And then we have an efficient portfolios right here, yeah. The nearest one goes into the this one, yeah, and then to the SML, yeah, and more efficient one. Remember that one, okay? And then the optimal capital structure. What is the appropriate combination of a debt and equity? This is the one I mentioned to you guys before. The appropriate combination of debt and equity. If a firm with 100% equity finance or the debt ratios is equal to 0, then the financial risk would be 0. That's only the business risk would exist, and the weighted average cost of capital would be equal to the cost of equity. Yeah. Initially, the use of debt may reduce as the lower cost of debt is combined with a higher cost of equity. Beyond some point, however, as added financial risk drives up, both the cost of debt and the cost of equity will increase. Okay. Now, at what level of financial leverage will be minimized? Technically, when we're dealing with a financial leverage, that means that we're dealing with the external sources of funding. That means that what level of financial leverage will be minimized? But technically, it will be minimized. Yeah, it will be minimized at the less of a debt to asset ratios or lesser dependency on the external debt, which is say a less number of debt. That means that the financial leverage will be decreasing as well. Remember, yeah. Okay. Uh, now, what else? Okay, the marginal cost of capital. This is just a little bit review, yeah. Okay, the marginal cost of capital. The MCC basically is the cost of retaining an additional dollar of a new capital. If during a given period of time a firm tries to raise more and more capital, a higher cost of capital may result. Whenever any of the costs of the individual sources increase, the weighted average cost of capital must be recalculated to reflect the cost of obtaining additional capital. To develop an MCC schedule, all breakpoint must be determined and each point K must be recalculated. A breakpoint is a level of financing at which Ka increases because one of the individual costs increased. An example of only retained earnings breakpoint will be illustrated. In practice, however, changes in the cost of all components must be taken into account. You can see right here, yeah, uh, how much exactly, is the breakpoint, yeah. This is how you can calculate it. Addition to the retained earnings, which is basically required, divided with the weight of common equity. That's for the breakpoint, yeah. If it doesn't compare to this breakpoint, then the number of the cost of capital will be slightly increased. Okay. Therefore, at this point, the management needs to decide, whether they would invest more, they would invest more, to basically decrease the number of, cost of capital, or whether they're gonna let it be. Yeah, whether they're gonna let it be, so the level of the cost of capital is likely increase. It depends on the management. Okay. A firm should continue to invest funds as long as the rates of return received on the investment exceed the firm's of cost of acquiring the investment capital. In the following graph, the firm should accept projects A and B and reject the project C. Yeah, the point of intersection determines the firm's optimal capital budget and the firm's cost of capital for its average risk projects. You can see right here, A and B. Yeah. You can see right here, the amount of a new capital, A and B. It falls into this one and it falls into this one, which is basically slightly higher, slightly higher than this one, than the MCCs. Therefore, it would be, we can say that it is fairly safe, to, tackle on this project, However, for the C as well as the D and E at this point, because it's slightly decreased, it was slightly, level of this one, above this one is basically decrease, minimum, it represent, it is not good opportunity for the project, for the company to handle all these projects, because technically it's lower than this one. This one serves as the, yeah. Let's just say what can we say? This is the limit. Yeah, this is the limit. Anything higher than this point, it should be good enough. That's for the company to tackle. But if it's lower than this one, then it is not good enough because the profit, it will not be as profitable for the company. Yeah, only gaining no types of risk itself. Yeah. However, it can be depends on the companies itself, whether the company want to, go with which project, because you know that, I've already mentioned to you guys before when we talk about the project investment by the company, that we have two criteria. The first one is the quantitative assessment by using this one, project evaluation, and then the second one is talk about the qualitative assessment, which is basically only the thermal companies will only know about that one, right? And then from this point, from this course, quantitative versus qualitative. The manager make a suggestion, recommendation based on these two, and then compile it in a document and give it to the board of director. Give it to the board as well as the CEOs, right? And then to decide which one is basically they're gonna be, follow through. On the next year. Okay. The next project after this. Okay, I think we're done for our session for today. Thank you very much for listening. And then if you have any questions, you may put it on the forum, or you may WhatsApp me directly. And then we should meet again next week. And Assalamualaikum.